And hello, back again here for Market Open and JOLTs job openings and Jerome Powell speaking again. We have some major news in about 10 minutes, so let's see where the market is right now. We will have Fed Chair Powell speaking in about 8 minutes, JOLTs job openings, and yeah, a lot of movement probably. So the market didn't move really much here on the news prior to the open on ADP non-farm employment change. It was higher than expected. I live streamed pre-market, but yeah, it was a small drop of about 50 points, but nothing really big. As you can see, the lows were here at 12,145 points. So the Fibonacci is working pretty well right now. As you can see, we hold the level here and are waiting for the news. We tried to retest pre-market highs, as you can see here, 12,216 points. Still no decision is made here, and we wait for the news. So Tesla is interesting because we dropped now below the previous neckline here. So we had this head-shoulder formation, and I talked about it in the previous live streams. As soon as we go below this, we will have room here back to the 170, 157, and even the $145 area to close this open gap here. So yeah, we are down now 3.3%. It's not looking good for Tesla. If the market is not recovering and Tesla is able to show this as a false breakout to the downside, then it's not looking good for Tesla here on a technical term, because the $187 is now acting as a resistance. So yeah, all the bears are happy now that we finally broke below the previous lows, and all the bigger traders now left their positions and gave them to retail traders. You can clearly see that there was some shift here, and still high volume. So a lot of small traders stepped into long positions here, and the large traders just went out of their long positions they have taken here during this rise of 100% since the beginning of this year. So a correction is just normal, it's just healthy, and I would wait for it before I would go in long again. Minimum 157, better 145 to take new longs in Tesla. Nasdaq still sitting here on a support level. Let's see ES again for S&P 500. So ES is making a doji right now, almost break even on the day, right below the important 4,000 level, which acts as a resistance right now. And you can see there's the 50% Fibonacci level sitting. So this one will be important to stay above if we want to be green in the next days, because it will act as a resistance right now. Yeah, the market is doing nothing until 10 a.m. Eastern. It's really a tight range. Everyone is waiting for the news. So sugar is going down right now, 0.9%. It's looking better for my short position. The same for orange juice. Orange juice is down 1.7% today, so also good for my short position. But natural gas is not so well. It's down 3.5%. We talked about it. It could still retest the previous lows here at the 230, but this should hold at the latest. And if not, then I will be out of my short put position as well. I will leave my long future position here if we go below 265. Still some room, but it's just normal for natural gas to make weird movements on a day. As you can see here, we had these giant hammer candles with huge wicks on the downside. So this happens pretty often. Back to Euro USD. Where's my chart? Too many open charts here. Here. So it's break even right now. So we were down pre-market It's looking a little bit more green right now. So if we take it as an early indicator for the stock market, it's good, it's green, but not really bullish. So we will have to wait for the news here as well. Let's see VIX. VIX is at 19.66, so up 0.35%. Nothing special. Everyone is waiting for the news and for Jerome Powell to speak again. Gold prices up a little bit, 0.3%. Just a small recovery from yesterday's 2% drop here. Crude oil is down 1.1% again. There's still some room to retest 75 here, this smaller uptrend. And the wheat prices are dropping again 1%, retesting yesterday's lows. Just on my watch list, no trades so far here. Back to Nasdaq. And the bulls are trying to push back here. VWAP is sitting right here at the 9 EMA level. All the moving averages and VWAP are together on this 15-minute time frame. We can have a look on a 5-minute time frame. That is almost looking the same. Trying to push above VWAP here right before the news. Same like yesterday, right before the meeting, prices are going crazy. So let's see the FedWatch tool. We are at 75%, just reloading if anything has changed. So we were at 80% pre-market. So we had even higher expectation than yesterday on the closing, and we went down again now to 72%. Still a lot higher than yesterday with about 70%, but we were at 80% pre-market. So you see the fear is getting out a little bit here. And we are waiting for the meeting here. In a couple of minutes they will start, but at first we will look at JOLTs job openings here. I will just prepare it so that we can see both together. 1-minute chart of Nasdaq and the economic numbers. Okay, let's see the outcome of JOLTs job openings. Last time it was 11 million. This time the forecast is 10.5. As you can see, the previous 4 times we were above expectation, and the expectation was between 10 and 10.3 million. This time it's 10.5. So it will be interesting if we can go above again. This would be bearish for the market, but if we would be in line or lower, then we can rally to the upside. This would be my perfect scenario because I'm in a smaller long position right now. But like always, I don't trade the news, I trade direction of the markets. And for now, it's a strong support sitting here, but when the numbers are out, this can change pretty fast. So numbers are out. Market tried to dip here, and we are turning to the downside. So the number is probably higher than expected. Let's see if the numbers can already be seen here. No, nothing so far. Let's see, we retest the lows. Lows of yesterday, lows of pre-market here. Pulling further down, 12,135. Next support is here, 12,060. Market's already trying to push back. Here's the number, 10.8 million. Again above expectation, even if the forecast was high. Lower than the previous number of 11 million, but 10.8 is still strong job market. It's nothing good for the new. Not good, not good, not good. Let's wait and see what the market is doing with these news. So we will probably retest the next support here until the meeting starts. Let's see if it already has started. Yes, here they are. Why is this watch not on time? It's already 10 a.m. Okay. So this was a, what was it? About 70%, 70 points drop here. Nothing big, but nothing unusual when the numbers are hotter than expected, like here. 10.8 million. Not really good. Let's prepare for the turn. Like yesterday, we had hotter than expected numbers and we had the turn. So let's see this again from yesterday. So yesterday we had the push down and then we went almost all the movement back again before we pushed further down. So probably we will see the same volatility today. Some pushes to the downside, rejections to the upside, especially when Jerome is speaking. So here's the pushback. And we are above the support levels again. 5-minute candle hasn't closed yet. That's why it is important, always wait for the closing of the candle. Never step into a position too early. Of course, you need to have your stop losses in place, but sometimes you are wigged out, like here. But let's wait for direction. You will always get a second chance to enter position, sometimes even at the lower and better price level. So let's see VIX now. VIX at 19.7. No changes here. It pulled up to 20 and went back again. Gold. Where's my gold price? Too many charts here, right below the VIX. So gold is pulling higher a little bit. $1,825, pulling back again. Let's see, Fed Watch tool. It was 72% and is now at 75%. So it is up a little bit again, but the high point was 80% pre-market. We'll begin shortly. Yeah, everyone is waiting for you guys. So let's see ES future again. Almost no changes here.
Objection. All members will have 5 legislative days within which
now
to submit extraneous materials to the chair for inclusion in the record. And I'll note at the outset that this hearing has a hard stop of 1 p.m. This is traditional for the Fed chair, which we intend to strictly observe. I now recognize myself for 4 minutes to give an opening statement. Thank you, Chairman Powell, for your testimony today. This week, you stated that the Fed will, quote, stay the course until the job is done, and that is to restore price stability. This is positive.
We are back at the breakout level.
But you know as well as I do, you're facing a very strong headwind from the political left. Democrats are pressuring the Fed to stray from its narrow mandate. It's a page out of their same old progressive playbook. When they don't have the votes to achieve something here in Congress, they turn to regulators. And now, Chair Powell, they're looking at you. in the Federal Reserve. President Biden's kowtowing to the far left is what got us into this inflationary mess. I urge you to reject the ideologues who put their social agenda ahead of economic prosperity. High prices continue to eat away at workers' wages and retirees' incomes. Since President Biden took office, we've experienced inflation at rates not seen
It's a
since the
worldwide
late
problem,
70s and
not a
early
US
80s.
problem, the high inflation.
Rapidly accelerated after Democrats passed their so-called American Rescue Plan, which poured nearly $2 trillion of inflationary fuel into the economy.
Yes, Carlos.
By June of last year, the Consumer
Just
Price
smoke
Index
and
showed
mirrors.
inflation skyrocketed from below 2% to nearly 9%. And personal consumption expenditures, the Fed's preferred measure of consumer prices,
Or like we
ballooned
say in
to
Germany,
7%.
political exchanges
Instead
have
of
short
being
legs.
rescued by Democrats, Americans were punished with pain at the grocery store and sticker shock at the pump. While inflation is now it is now below its mid-2022 peak, it is persisting at rates well above the Fed's target. It remains broad-based and continues to hammer Americans' pocketbooks. In fact, a recent Gallup poll shows half of the respondents say they are worse off financially than a year ago. It's clear that there's still a long way to go in the effort to bring down costs. I look forward to hearing you reaffirm your commitment to that work today. Republicans also want to hear from you regarding some concerning developments at the Federal Reserve on the regulatory front. Recently, the Federal Reserve's Vice Chair for Supervision announced a quote-unquote holistic review of bank capital in the Fed's regulatory regime. However, it seems that only a small group within the Fed knows what this means, what it entails, how much review is being vetted by the full board, and the type of quantitative analysis the Fed is performing. The Fed shouldn't operate in the shadows, especially when the regulation in question can have broad and significant economic effects. It's also unclear the motivation for the Fed's holistic review, particularly when so many board members have stated that the banking system is very well capitalized, and any review of capital standards should be targeted. It also appears the Federal Reserve Board is laying the groundwork for climate policy to be implemented through the Fed regulation with an opening salvo to quote-unquote scenario analysis. Addressing an issue like climate change is important, but a policy that should originate here in Congress by the elected representatives of the people, not the central bank. As you said, the Fed needs to stick to its knitting. I agree. There is concern from many that the Fed is picking up new needles and knitting partisan sweaters. At such a precarious time for our economy here at home and the global economy, that would be a mistake. Thank you for being here today. I look forward to your testimony and the questions by our members. The chair now recognizes the ranking member of the committee, Ms. Waters, for 4 minutes for an opening statement.
Thank you very much, Mr. Chairman. Good morning, Chair Powell. Since your last visit, our country, under the leadership of President Biden, has made major progress to improve economic conditions, including adding a record 12 million jobs.
So funny to hear all these politicians.
Unemployment to its lowest rate in 54 years, while also reducing the deficit by $1.7 trillion. Unfortunately, many families are still struggling
$1.7 trillion
to afford basic necessities because of inflation. What's more, interest rate hikes are making borrowing, especially for mortgages, outrageously expensive. Since I raised this concern for you in a November letter, the rate hikes continue to have an outsized impact on housing costs, which are, as you know, a primary driver of core inflation. But, Mr. Chair, I think that you will agree that Congress also has a role. That's why I'm somewhat disappointed that after 2 months, Republicans have taken no serious action to address inflation. By this time last Congress, House Democrats had passed the American Rescue Plan to provide relief from the ongoing pandemic, which included our committee's
Here's the push.
efforts to provide $70 billion for homeowners, renters, businesses, and first responders. If Republicans are looking for ideas, committee Democrats have put forth additional bills, like the Build Back Better Act, to bring down costs for Americans, especially housing costs. Even more concerning, we're just months away from an economic catastrophe beyond what we have ever seen, including spiking interest rates, massive job losses, and global instability. I'm talking about the threats by Republican leadership
Still in the range,
to
no
force
breakout
a
yet.
default on our nation's debt if we don't agree to their demands to cut Social Security, Medicare, or other critical programs. We've urged Congress to
now.
take immediate action to raise the debt ceiling. But rather than focusing on this very real issue, the first bill that committee Republicans brought to the floor instead suggested that Social Security and Medicare are socialist threats to America. Since then, we have considered legislation related to deregulating securities and banking laws and countering threats from China, but Republicans have completely ignored the biggest economic threat to businesses, consumers, and our economy, defaulting on our debt. Last month, I wrote a letter to Chair McHenry urging him to take this matter seriously and hold a hearing, but I'm still waiting for a
And
response.
it's not only the
I
country's
hope
debt,
Republicans
it's also
will
private
listen
debt
today
and credit card
to the
spending.
real consequences that even the mere threat of a default would have for everyone in this country. And finally, I'm so pleased that we're finally making progress on diversity and inclusion for key positions at the Fed, including last year's historic confirmation of Dr. Lisa Cook to serve as the very first Black woman on the Federal Reserve Board, with the board's vice chair and Kansas City Fed president positions vacant. I think President Biden and Kansas City Fed Board should build on this progress by seriously considering diverse candidates for these positions. With that, I yield back the balance of my time.
The ranking member yields back the balance of my time, asking unanimous consent to submit for the record my letter to Secretary of the Treasury Janet Yellen from February 28th, asking for an update on the ex-date for the debt ceiling. I also ask unanimous consent to submit for the record the latest CBO long-term budget outlook on the unsustainability of our debt, most recently released. And without objection, so ordered. I'll now recognize the Chair of the Financial Institutions Subcommittee Chair, Mr. Barr, for 1 minute.
Thank you, Mr. Chairman. And Chairman Powell, thank you for being here today to discuss the Federal Reserve's monetary policy actions in a time of economic uncertainty, mixed economic data, historic inflation that continues to plague families and businesses around the country. It is paramount that the Federal Reserve remain vigilant on reducing inflation, anchoring inflation expectations, and restoring price stability at the Fed's 2% target. I also look forward to discussing the Fed's regulatory and supervisory activities. As the Fed reviews the bank capital framework, it needs to consider the impact to the real economy and our global competitiveness when raising capital requirements and sidelining capital would work at cross purposes with monetary tightening, constraining the supply side when we need more, not less, investment to fix supply chains and reduce inflation. Tailored regulations are required of the Fed by law, and a one-size-fits-all approach would be the wrong path to take. Finally, I urge the Fed, in your words, to stick to its knitting and not attempt to be a climate regulator. I yield back.
Gentleman's time has expired. We'll now recognize the ranking member of the Financial Institutions Subcommittee, Mr. Foster, for 1 minute.
Thank you, and thank you, Chair Powell, for being here today. Today is the 15th anniversary of when I was first elected to Congress and placed on the Financial Services Committee, just as the economy was about to collapse. And so that was my trial by fire, the emergency response to rescue the economy and the legislative response, the Dodd-Frank Act, that successfully stabilized our financial system. So 15 years later, as I take my place as the ranking member on the Committee of Oversight over U.S. Banking and Monetary Policy, I recall the solemn oath that I swore to myself back then to make sure that this kind of calamity never happens again. The monetary policy report that we're receiving today is largely a narrative of a return to normal. Lead times to manufacturers are back to pre-COVID levels. The job market retains supernatural strength, and inflation is responding
Return to
more or
normal.
less as predicted to the usual measures. And by far, the largest threat on the horizon is a repeat of the 2011 default crisis. Congress has the power to avoid that, and we owe it to the American people to do so. And I yield back.
Today, we welcome the testimony of Jerome Powell, Chair of the Board of Governors of the Federal Reserve System. Chair Powell was reappointed and sworn in for a second four-year term as chair on May 23, 2022. Chair Powell also serves as chairman of the Federal Open Markets Committee and the system's principal monetary policymaking, which is the system's principal monetary policymaking body. Chair Powell, we thank you for taking the time to be here. We will recognize you for 5 minutes to give an oral presentation or testimony. Without objection, your written statement will be made part of the record. Chairman Powell, you're recognized.
Chairman McHenry, Ranking Member Waters, and other members of the committee, good morning. And I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. My colleagues and I are acutely aware that high inflation is causing significant hardship, and we're strongly committed to returning inflation to our 2% goal. This year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our tightening so far are yet to be felt. Even so, we have more work to do. Our policy actions are guided by our dual mandate to promote maximum employment and stable prices. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. I will review the current economic situation before turning to monetary policy. The data from January on employment, consumer spending, manufacturing production, and inflation have partly reversed the softening trends that we had seen in the data just a month ago. Some of this reversal likely reflects the unseasonably warm weather in January in much of the country. Still, the breadth of the reversal, along with the revisions to the previous quarter, suggest that inflationary pressures are running higher than expected at the time of our previous FOMC meeting. From a broader perspective, inflation has moderated somewhat since the middle of last year, but remains well above our longer-run objective of 2%. The 12-month change in total PCE prices has slowed from its peak of 7% in June to 5.4% in January, as energy prices have declined and supply chain bottlenecks have eased. Over the past 12 months, core PCE inflation, which excludes the volatile food and energy prices, was 4.7%. As supply chain bottlenecks have eased and tighter policy has restrained demand, inflation in the core goods sector has fallen. And while housing services inflation remains too high, the flattening out in rents evident in recently signed leases points to a deceleration in this component of inflation over the year ahead. That said, there is little sign of disinflation thus far in the category of core services excluding housing, which accounts for more than half of core consumer expenditures. To restore price stability, we will need to see lower inflation in this sector, and there will very likely be some softening in labor market conditions. Although nominal wage gains have slowed somewhat in recent months,
Softening
they
in
remain
labor market
above what is
conditions. Yeah, we are
consistent
still
with
waiting
2%
for this.
inflation and current trends in productivity. Strong wage growth is good for workers, but only if it's not eroded by inflation. Turning to growth, the U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Although consumer spending appears to be expanding at a solid pace this quarter, other recent indicators point to subdued growth of spending and production. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight. The unemployment rate was 3.4% in January, its lowest level since 1969. Job gains remain very strong in January, while the supply of labor has continued to lag. As of the end of December, There were 1.9 job openings for each unemployed individual, close to the all-time peak recorded last March, while unemployment insurance claims have remained near historic lows. Turning to monetary policy. With inflation well above our longer-run goal of 2% and with the labor market remaining extremely tight, the FOMC has continued to tighten the stance of monetary policy, raising interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to bring inflation down to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee slowed the pace of interest rate increases over its past 2 meetings. We will continue to make our decisions meeting by meeting, taking into account the totality of the incoming data and their implications for the outlook for economic activity and inflation. Although inflation has been moderating in recent months, the process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. As I mentioned, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If, and I stress that no decision has been made on this, but if the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes. Restoring price stability will likely require that we maintain a restrictive stance of monetary policy for some time.
Yeah, super
Our
choppy.
overarching
Lucas.
focus is using our tools
The longer
to bring
we
inflation
stay in
back
the
down to
sideways
our
market,
2%
the
goal
harder the
and
push
keep
will be
longer-term inflation
when we see the
expectations
breakout.
well anchored.
Because more stop losses will be
Restoring price
triggered.
stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect
Yes,
communities,
I have a
families,
small,
and
long
businesses
position,
across
Lucas.
the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you, Chairman Powell. I'll now recognize myself for 5 minutes for the purposes of questioning. Chairman Powell, there's been a lot of discussion over the last 24 hours about the effect of rate increases on the economy, a lot of debate about what you said yesterday in the Senate. But no one asked you this directly. We have a March meeting coming up, Open Markets Committee meeting coming up in 2 weeks. How do you think about the March meeting? What's your approach to that? What are we likely to see?
And beginning Sunday,
Thank
we
you.
are in
So
the quiet
I
period.
won't repeat what I just said in my testimony, but if I turn to the March meeting,
So they are not allowed
I guess
to
I would
speak
say that
anymore
we have
before
some
the meeting.
potentially important data coming up, data to be analyzed. One of them came out at exactly 10 o'clock. That would be the JOLTs report, which of course I haven't seen, being sitting here at 10 o'clock. But we're also getting a jobs report on Friday and a CPI and PPI inflation
Non-farm
report
payrolls.
next week. So those will be important and we'll scrutinize them.
Yeah.
When we say that we're going to be looking at the totality of the data, which is what I said, that does include these reports yet to
They are
come.
not
They're gonna
allowed
be
to talk
important in our
about
assessment
CPI
of the
before the
higher
meeting.
readings that we have very recently received,
Therefore, we
and
will
of
be
the
in a
overall
black
direction
period
of the economy and of our
for the next
progress
2
in
weeks.
bringing inflation down. And we'll be careful in analyzing them. Again, we have not made
Here's
any
the
decision
outbreak,
about the March meeting.
12,200.
We're not gonna
Let's
do that
see if
until
it's
we
final.
see the additional data. The larger
Just some
point,
stop
though,
losses
is
triggered.
that we're not on a preset path and that we will be guided by the incoming data and the evolving outlook.
But you've also said higher, longer.
Here's the change
Is
of
that still the
parabolic,
case?
went to the downside.
Yeah, so, and as I said in my
indicating an
testimony,
early uptrend.
we look at the data since January and also the revisions to the November and December inflation data.
Same
and they
here with
suggest
ADX.
that the ultimate level of interest rates is
So to
likely to be
repeat,
higher than we'd expected.
And what are those economic factors?
So going back to January, as I mentioned, the softer inflation readings of November and December were revised up. We got a very strong inflation report for January. We got an extraordinarily strong employment report, very strong consumer spending, strong manufacturing data right across the board. And as I pointed out, some of that may have been affected by very warm January weather, but nonetheless,
Look here
all of
behind,
them pointed
she's
in the
saying.
same direction.
Nasdaq is
Now,
up.
let's move
It's
to
good.
regulation. Chair Powell, in January, the Federal Reserve put out a policy statement noting that digital asset custody is a permissible activity if done in a safe and sound manner. However, if a bank can demonstrate to the Fed that it can conduct that activity in safe and sound manner, the capital impact of the SEC's staff accounting bulletin effectively precludes banks from offering digital asset
Oh, let's do
custody
5 more
service
minutes.
at any scale.
Then I
Are you
would
aware
let you trade
of
on
the
your own.
staff accounting bulletin by the Securities
Pretty
Exchange
choppy
Commission
today.
and its impact on custodial services?
Like expected, the market
I
can
am
turn.
aware of it. Of course, it's an
really
SEC
fast.
accounting bill. This is SAB 121, I think, and
That's
I'm
right.
certainly aware of it. And we do follow general accepted accounting principles in our
Yes.
capital regulation.
Okay, well, without objection, I'll submit to the, submit for the record, my
Correct, Dylan.
letter to
Triple
the bank
witching this
regulators
Friday.
about this. So while the Fed says it
All
can be done in a safe and
futures,
sound
index
manner, the Securities
futures,
Exchange Commission
commodity
has regulated it
futures.
so that it cannot be done.
And
Next question is
Stock options are
certainly about
expiring.
bank capital standards. You got questions about this yesterday. Chair Barr has announced a holistic review of capital requirements. As I said in my opening statement, there are a lot of questions about this process. And previous statements by members of the Fed governors about the adequacy of current capital standards. And so while the Vice Chair for Supervision has announced that the Fed will engage in a holistic review of capital regulation, is that Fed staff? Is that done at the, at the governor's, the board level? What is the process? There are a lot of questions that people have about his statements. And so we want to understand why it's necessary for the Fed to conduct a holistic review and what that process is. So, my general question is, do you still agree with your previous statements about the adequacy on a generalized basis of our financial system? Or are we to read into this that we're not adequately capitalized and there's a high level of risk in the system that we're unaware of at this point?
Thank you. So the why really just is that as a new Vice Chair for Supervision, Vice Chair Barr has launched into, he's taking a fresh look at everything, including capital. That actually is typical of the last two people to have this job. So that makes a lot of sense. In terms of the process, it's certainly conducted under Vice Chair Barr's leadership with input from the staff and discussions with governors on that committee. And I'm kept broadly apprised about what's going on. But the bottom line is nothing has been proposed to the board. Nothing has been formalized at this point. It's a lot of work that's going on. I think discussions are going on,
VIX is
meetings
back
with
at
industry and that kind of thing.
19.6.
When we get to the place where that's appropriate, the board will be carefully briefed. Ultimately, we'll vote on a proposal, and that proposal will go out for comment, and we'll
Crude oil still
solicit
down
comment from
about 1%.
any and all commenters, and we'll look very carefully at that. So it'll be a wide open
Tesla down
process in the sunshine.
3.1%.
Thank you. I yield back. Now recognize the gentlewoman from California, the ranking member, Ms. Waters.
Thank you very much. Chair Powell, I
Curious
agree
the
with
break
what
even?
you said on February 1st, that Congress must raise the debt limit
ES break even.
because of what you described as the highly risky consequences of failing to do so. You are perhaps the most important expert on the debt limit, which is why I find it very concerning that your recommendation to
79%.
raise the debt limit in a timely manner is being ignored by my colleagues on the other side of the aisle. I'm also concerned that the consequences of this brinksmanship are imminent. Fitch Ratings said this week they may seriously look at downgrading the U.S. debt based on the escalating brinksmanship they are observing, even if Congress ultimately addresses the debt limit at the last minute. This is history repeating itself. Standard & Poor's downgraded our debt back in 2011 when Republicans last controlled the House and threatened
Come
default.
on, ask your
The
questions.
Bipartisan Policy Center later found that the 2011 debt limit debate cost us $18.9 billion in higher borrowing costs, even though we never defaulted. To put that into
No, you
perspective,
didn't
that
miss
could
anything,
have been
Carlos.
leveraged to provide
Nothing,
up
really,
to
nothing happened.
200 billion in loans to small businesses through the state Small Business Credit Initiative, or to provide hundreds of thousands of people down payment assistance to buy their first home.
Crude oil
So I
inventory
want
is
to
down.
emphasize that House Republicans, including most of the Republicans on this committee, had no qualms about paying our debts when Trump was in office. 3 times they addressed the debt ceiling in a timely manner without holding our country hostage. But Republicans now are ready to tear down the hard work of Americans everywhere to weather the pandemic.
But you see,
and
with the
build
debt
back a
ceiling,
strong
the
recovery.
market
Chair
doesn't
Powell,
care.
Can you
We
describe
know
for us the
that it's
risks
stupid
you
to
see if
have this
Congress
debt ceiling.
continues to delay
Because
action
every time
on the
it is
debt
lifted.
limit, both for our economy
Just
and
ridiculous.
for individuals and families?
Let me
It's
start
useless.
briefly by saying that we have no role and seek no role in what is really at the heart of fiscal policy, except I will limit myself to the 2 things that other Fed chairs have said about this. One is just that Congress raising the debt ceiling is really the only alternative. There are no rabbits in hats to be pulled out on this.
Exactly.
2 really is just that no one should assume that the Fed can protect the economy from you know, the non-payment of the government's bills, let alone a debt default or something of that nature, which we don't think will happen here, but no one should be thinking that we have the tools to protect the economy from all the potential effects of that.
Thank you very much. I don't want to miss what you said. I somewhat quoted you when you said that Congress must raise the debt limit because of what you described as a highly risky consequence of failing to do so. Is that your language?
Well, must in the sense that it's really the only way for the debt limit to be raised is Congress must act. Again, these are fiscal discussions, and we're not.
If you do not
we
want
don't
to
wanna be a
default, you
part
have
of
to
them.
raise it, yes.
Really, they're between.
There's no
elected
alternative.
officials.
But you are an expert on the subject.
Well, I spent a lot of time on this, as you'll recall.
As an expert
Prior
on
years.
this subject, you are concerned about the high risky consequence of failing to do so. Is that correct? Did I correctly quote you?
That's correct.
Thank you. And so, again, let
He
me
wants to
just
play
go a little bit
Jerome
further.
Powell against the Republicans.
The chair mentioned that he
Really
had
stupid
either
politics.
written a letter or maybe even had some
Nothing is working for
conversation
breakout
from
here.
Janet
Look.
Yellen about the
And
time
we are
limits
pushing.
that she had attempted to describe. Is it your understanding that she said she could
Above
maneuver
pre-market highs.
and kind of manipulate things so that she paid the bills that were coming due, but this could only last until about June? Is that your understanding?
Honestly, I would really have to not try to interpret the secretary's words for you. That's really up to her to do.
Can she keep us afloat until about June?
I don't, honestly, that's not for me to say. These are really questions for the secretary. I'm sorry.
Have you had any conversation with her about the statement that she made about being able to manipulate the debt and pay bills that were coming due out of another account, et cetera? Did you have that conversation with her?
The conversations that you and I have privately don't go anywhere.
That is a good answer.
Conversations I have with Secretary
Nothing to
Yellen,
do
I
with
don't-
this.
I don't-
Okay, and I don't want to get you
Gentlelady
in a-
time is expired.
Beg your pardon?
The gentlelady's time is expired.
Did I have equal time with you?
You sure did. He went over time.
If I did, thank you. I yield back.
I now recognize the Vice Chair of the full committee, Mr. Hill of Arkansas.
Thank you, Mr. Chairman, and thank you, Chair Powell, for being with us. You're welcome anytime. Don't wait till we ask. If you want to volunteer and come, we love having your views on many topics. Thanks for talking about your commitment to price stability. You know, we've
Okay,
had
I
this
think we will stop it here. Just talk some last words about this meeting. Like always, just nonsense politics. They want to play out several cards against their political opponents. We have seen she wanted to put Jerome Powell on a hot seat and play him against the Republicans. It's just stupid and a waste of time. I want that the important questions are asked and that Jerome Powell has to answer the important questions and not give economic basic infos like yesterday or just talking about minorities again, like today again. Yesterday it was the Latinos, today it was the black women, and yeah, every time something different, but that's stupid and nonsense. Therefore, I don't like to watch these events because you are not more knowledgeable than before. Now we know the same things. The market hasn't moved at all. Why? Because there are no major news. It's a nonsense event, because if not the right questions are asked, then Jerome Powell won't answer. So there's no news, no major new news. And therefore, yeah, market is just moving sideways right now. We are trying to push above pre-market highs here. Next resistance 12,235. On a higher time frame, like 1 hour, we will see the highs from yesterday here around this area. Can be also important, but next major resistance is 12,330 points. This was a low point pre-market yesterday. So I want to take out some profits here, just to keep on a lighter position and let the rest just run. Maybe we'll see 12,400, maybe not today, but maybe tomorrow or on Friday on non-farm payrolls. Just want to take out some profits here around 12,300, where the highs yesterday during the market session was. And yeah, I will just let my winners run. It's looking good so far. This candle is pretty nice on the hourly time frame, but we will have to wait for the closing of this candle. It will probably close near the resistance here, but if we manage to go higher, it's even better sign. So just wait for the closing, but the bulls want to take over. It's not super bullish, but it's more bullish than bearish right now. You can see parabolic is in terms of the bulls here on the 1 hour time frame, and on a 4 hour time frame it is still bearish here since yesterday. We will have to wait for the break above the moving averages and this Fibonacci level here, 12,335 points. Then it's looking more bullish here. On a day chart, it's still just in a correction here, since we had this doji candle the day before yesterday, but we are above the moving averages, or right at the moving averages, above the 50% Fibonacci. So it's still good, it's okay. We had a wick down here on the news. Some stop losses were probably triggered, but it's still bullish. And yeah, I'm still in my small long position and happy that it's playing out good right now. Let's wait if the market stays in this bullish mood, or if Jerome Powell is forced to say something real important. I don't think that this will happen, but you never know. The market is doing what it wants to do. So let's stay patient and always keep an eye on direction. This is what we trade, direction and market patterns, and not any news. We just trade direction. Okay, just one look into the chat. Triple witching, yeah, this will be important, especially because of 0DTE again. So keep a close eye on Friday and 0DTEs, where we will see maybe max pain. So let's go just to max pain and see for expiry on Friday with the options. So for Spider, we will see the expiration on 17th. So next week will be even more important, because there we will have triple witching. So the next Friday will be even more important and there we have the max pain level at the important 400. So we are near this level right now. Let's see the same for Tesla. So Tesla on 17th is 185, so about the level where we are right now, but a lot of puts are here at lower levels, so there are some walls that have to be broken before we can turn down to the 160 or 145 area. Let's see if this can happen on the expiration next week. So here the max pain level is 195. We are far below right now, but yeah, like always, the market can turn pretty quick. Therefore, let's wait and see. Just be patient. It's popping like popcorn. If you call this a pop, then wait for CPI day. There will be more popping, because this is not a real pop. Just 50 points for Nasdaq. It's just almost no movement. I have a question. Why are the European indexes basically setting all-time high right now? Yeah, the biggest difference for the European indices is that they are a little bit different in calculation than the US indexes, because here you have not a compounding index, because all the dividend payments are deducted. So S&P 500 and Dow and Nasdaq are not compounding indices. Therefore, there's a big difference if you are looking at them for a longer time frame. Because if you look at DAX, for example, I will just go back to DAX here, DAX 40. It's a compounding index. So all the dividend payments are reinvested in the index and not deducted. And therefore, of course, we have the ability to stay on higher levels. But it was weaker in the previous years than the US markets, because we had low interest rate levels. And this is normally a big factor for the companies which are growing really fast. So for all the tech companies, and we have only a small amount of tech companies in the big 40 companies in Germany, for example, or in whole Europe if you are looking at the Euro stocks. So therefore, these companies are from the old economy. They are sometimes 50 or 100 years old, and they can better act with higher interest rate levels. It's not such of a big issue because they have only low debt, and therefore they can act better with a higher interest rate levels. This is more of an issue for the US economy and for the US companies, because you have higher interest rate levels in the US than in the Eurozone, and there are more companies which have no gains. So they are still sitting on losses and are not producing gains, and therefore it's a bigger issue for them not being profitable, because the banks won't borrow them more money on high interest payments, because they are not able to pay these interest payments. And therefore it's more of an issue for the US companies than for the European ones, and therefore we now see the shift back here into the European stock market. Even if the US dollar is getting stronger, the European companies are now stronger than the American ones because of these higher interest rate levels, because it's old economy, and old economy is just stronger with higher interest rate levels than the fast growing financial economy or tech economy in the US. That's what I would say is the biggest difference, and why the markets are rising this fast, because even US investors are seeing that you can buy cheap companies here now. It was pretty cheap previous October, but it is still cheap now compared with the high inflation rate, because the prices were set higher by the companies here, so they are producing higher earnings and higher gains, and therefore the prices of the stocks should be higher. And this is what now all the investors are seeing, and therefore they are buying heavy back into German and European stocks. Okay, feels like a comedy show listening to the politics. Yeah, sometimes it's nothing different. Sometimes even better than comedy, because you can laugh really loud out when you hear these stupid hearings and questions. And yeah, what should Jerome Powell answer else than saying, "I cannot answer this question. You have to ask someone else than me." Sometimes it's ridiculous. Okay, I wish you a happy trading day today. Hope you will have some decent profit. Let's meet on Friday again for non-farm payrolls. Then hopefully we will see the main direction the market wants to move in. I want to see some higher levels. I will for sure be out of my long position. I want to close it today or at the latest tomorrow. But I want to see higher levels for taking on new short trades for a longer term or midterm, for a nice swing trade for maybe several hundred points. But I'm waiting for higher levels to come. Minimum 12,500 is what I want to see to take on a bigger short position here. Nothing right now, still waiting for the direction. So I wish you a nice trading day. Thank you for watching. Please leave a like to my stream, and if you haven't done so far, please consider subscribing to my channel to be informed whenever I go live next time. Thank you for watching. See you on Friday. Goodbye.